And now I'm going to let him, John, why don't you introduce everybody, who you are and maybe a little bit of what you accomplished, try to hold back on the humility a bit so that we know who we're talking to.
Sure. Well, good afternoon and or close to good evening to everyone. So my name is John White. I'm in Metro Atlanta area, kind of closer to Alpharetta, Georgia, kind of the northern suburbs of Atlanta. I grew up in a small town in South Carolina on 38 acres with cows and chicken houses. And I had a chance to go to Anderson College to play baseball. So small town, small high school, small college. Kind of hear everything is small. And then I met my wife, who's from the Metro Atlanta area. That's how we got here. Got married in 2008. Married to Carrie, 3 children, Jack, Anna, and Sailor. And that's what my focus is today. They're my number one. While I'm thinking about this, someone once asked me, "Who's your number one client?" And I gave them the largest net worth of a client of ours. And he said, "No, Carrie is your number one client."
Yeah, baby.
Probably took me 10 years to really grasp that, but I'm very grateful that I have fully grasped what that means. After college, I played a year of minor league baseball, long enough to realize I was really good and long enough to realize I wasn't going to make much money playing baseball. So I gave that up and started my business. Grew up in probably the least exciting industry as you can. I'm a 3rd generation insurance professional. Actually, my great grandfather was in the life insurance business. And then my grandfather and my mother are in the insurance business. So I've been in the insurance arena and really wealth management as a whole. We do other things, but I kind of tell people, it's like, I'm a life insurance specialist, but our business does, wealth advisory services as well. And so with that being said, I've had my licenses for 15 years. So 39 years old, been doing this since I was 24. And, that's kind of where we are. So in the world of our industry, I'm partnering with another gentleman. They oversee about $600 million of assets now. And then there's $4.2 billion of life insurance that's been put in place. There's about $74 million of cash value of clients that we oversee. And none of that matters as much as 2 client experiences I had 2 years ago. I've had 2 clients pass away who were in their 42 and 43 years old. So I've seen the full process from going to, I meet someone who doesn't really want to be talking to me, to I'm sitting with their family when they're gone, and what that planning really means. So I would say my conviction is high. My patience for people and their lack of taking action on courageous decisions and just life in general has probably gotten lower, but what I love is leadership. I think you grow into the conversations around you. I believe life is about people and relationship. And I try to lead with the Holy Spirit on a daily basis. And that, if I could, in a nutshell, kind of sums up how we got here today.
Yeah, that's good. And I won't embarrass him. I won't make him talk about it. But John has spoken on stage in front of hundreds of people. He's a keynote speaker, so he's very gifted at that as well. All right. Some of these questions are just going to be selfish questions that I want to know. But why don't you tell us your morning routine? I'd love to know that.
Yeah, I think the morning routine starts with the night before, and it used to be like having the suit laid out and the dress shoes laid out. Now I'm in a t-shirt or golf shirt most of the time. But usually it's having clothes prepared for the gym the next morning. And that kind of starts the night before. And then it's a reoccurring alarm clock. So that started over 10 years ago. So I'm always setting 2 or 3 alarms just in case I put PM on one of them, which I learned that in college. You don't want to miss I can miss a class sleeping in, but you don't want to miss a team meeting by sleeping in. So usually there's a couple of alarm clocks. And so that's waking up on average. It's been about 5 o'clock in the morning. And today, that it used to be go straight to the gym. Today it's quiet time, morning time, reading, either leadership reading or spiritual reading in the morning. And then I take my kids to school 4 days out of 5 days a week. And then I hit the gym at 7:30. So that used to be 5:30. But I'm now finally kind of followed the book, The One Thing, where, I kind of protect before 9 a.m. is sort of, this sounds kind of sappy, like our cliche, me time. So prior to 9 a.m. is really me time, my mind, my body, my spirit, my love, my kids. And then, I'm ready to kind of hit the ground running about 9 o'clock. And then usually if I can, I don't have a client meeting till 10. So I have like 9 to 10. It's kind of like a buffer, gather yourself for the day. And then typically speaking, from 10 to about 4 to 5 p.m., I'm trying to wrap up.
Yeah.
And be done. I started my 2013. I learned how important it was for my family, for me to be present in the evening at a specific time they could depend on. So it didn't take too many times, probably more than it should, where, like, hey, I tell Carrie, I'll be home at 6, I get home at 6:45. I just learned that is not a good recipe.
That doesn't survive in my house, my friend.
So she always was supportive.
Text 501.
She always supported, now you have like the traffic or meeting ran long, and she would support me working as many hours as I need to. It's just more the expectation.
Yeah.
And so now my kids are old enough, they say, hey, Dad, it's 5:45, so that's 5:45 is usually the end of my day. So like even today, if we go till 6 Eastern, that is a little bit of a commitment on my end. And so we've made some adjustments to even be able to do that. Right.
Yeah.
And of course, for you and your group, Schuyler, obviously, we would always do that when we can. So, but the beginning of the day is critical to the success of the day. There's no doubt about it. Yeah.
Yeah. I can't remember when I started it, but the quiet time before the working out, I do think it's meaningful to get yourself in the right mindset, to just start your day with gratitude is the best way to start your day. You'll have a better workout. So there you go.
Yeah. Well, I will share this. I'm not getting into spiritual dialogue, but I think if you run a business, if you're looking to leave a company and be financially independent, or you run a business, or let's just say you're in a leadership role where people are depending on you, I think this is true for every situation, is that role or that business will put you on your knees. You know what I mean? And especially starting a new business where you're scared, or you don't know what's going to happen. There's no question it's a similar story for most people. And so I learned pretty early that my business or the world couldn't put me on my knees if I started the day on my knees, just in like gratitude and surrender of whatever comes at me today. As long as I got my spirit, my family, my health, it's gonna be okay. So just patience in the day is stronger, wisdom is stronger. More in an offensive position for the day.
Yeah.
And certainly I'm not in the military, and I don't ever want to misuse this, but it's like, we're taking, imaginary bullets all day long. You know what I mean? And when you put that body armor on early in the morning, you can, you can just handle more throughout the day.
Yeah.
It's my experience.
Yeah. I like that. So if you had to boil it down to one thing, as you look back over your career, what has made you successful in your business?
Well, I think in my business is for sure true. I think it's true in your family's businesses as well. And really my belief is everything is the people you surround yourself with. We met in Austin, Texas, because I flew to Austin, Texas, because a influential leader said, if you come see me, I'll spend time with you. And I knew at that point, prior to that who you surround yourself with, the leaders, the rooms, communities like this, is going to determine your future. And I think that was a gift that I learned really early from baseball, actually, because practicing with teammates who are good make you better.
Yeah.
And it's the same is true in business and life. So I have a philosophy of follow the people.
Yeah.
In my job.
So what is when you see somebody and you see these qualities, it's a talented person. What are those qualities that you look for?
Today it's people who are really putting others first. when they make decisions, are they including themselves in their decision making or not? Are they putting other people first? That's critical for me as an advisor. That my philosophy has been, if I put others first and I do what's right for the client, my business will be okay. My grandfather, who passed away 2 years ago, told me in my 20s, if you take care of your clients will take care of you.
Yeah.
So that can be as true as which head coach is my son's baseball coach.
Yeah.
Are they putting the kids first? Are they doing what's right for others? And those are the people that I want to be around. And then I just think, just leaders in general, people who are grinding and doing the work and putting others first every step of the way. Those are probably what stands out the most.
Yeah, no, I like that. Okay, let's shift gears. Let's go into the insurance talk here. My next question is going to be about the cash value plan. But what to you is a healthy insurance plan? And if you could talk about someone as an individual and someone that has a family, if there is a difference.
Sure. Well, depending on the types of insurance, typically, insurance is protecting an unknown, right? It's invisible. There's probably, I think, nothing harder to sell than something you can't touch. And so first and foremost, insurance is protection for things that go wrong that we could have the capital to pay for, but it's leverage in that we're using insurance to provide protection so we can put our capital at work somewhere else, which sort of removes the notion of being self-insured. I think that's kind of a misunderstood statement. If we have the money to pay for a home that burns down, would we still have homeowners insurance? Like, yes, of course, because that allows us to free up our money and invest it. So when it comes to an individual and income, it's really income protection. So if if you make $100,000 over 30 years, that's $3 million of income that someone's going to earn as long as they're here to earn that money. So kind of getting into a couple or family, that's the way I think about, I'm going to make a certain amount of money for my family and their vision unless I'm not here to earn that money. And there's sweat equity when you build a business. I think people have a different perspective when they've started and built a business. So when I built my business, I was making about $3 an hour. There were many nights that my wife is at home by herself and I'm working. That fruit is now is coming to fruition today, right? But it still has time to come. And so if something happens to me tomorrow, that fruit's never coming. So the insurance is protecting all that sweat equity that I used to build in my business. So that's one way. I think protection, personal insurance is protecting income. We are an asset. If we make $1 million a year, we're a $30 million asset at a minimum over 30 years.
Yeah.
Now we're a piece of real estate, would you insure it? So that's the way I think about life insurance. Then there's a component to life insurance that can be used as an asset. And that's kind of a different category. And so as an individual, you're thinking about if something happens, I can't work. How am I going to pay for my expenses? How am I going to get the care that I need? Health insurance, disability insurance. Anything else you care about or people you care about, that's life insurance, right? As a family, then you have a couple other factors in here. So how are they going to be without me financially? And insurance in a simple term can protect for that. Life insurance protects for that.
Yep. And I just want to be clear with everybody on the call. I have both term life insurance, and I have this cash value life insurance policy as well. And I remember from our very first conversation, John, you said that if you know you're going to be wealthy, there's no question about it, then the cash value life insurance policy is something that you want to really consider as a part of what you do in your journey here. So I guess first, could you explain the difference between term and cash value life insurance, and then explain to everybody that conversation you were having with me, so that they understand whether or not it would be a good deal for them?
Yeah. So term life insurance is just pure protection. There's no asset. It's like homeowners insurance, car insurance. It pays if there's a claim. A claim is, someone passes away. It's cheap and inexpensive. So, meaning you could have $2, $3, $4, $5 million of term insurance for several, $100 a year, a couple $1,000 a year. It's cheap because it's only a 1% chance that it pays out. So it's just pure protection. There's no asset value. The mindset there is when we're in our, 30s, 40s, maybe 50s, we need the most amount of insurance while our maybe kids are younger, or we have more debt or things like that. So I highly recommend term insurance. It's a simple, easiest way to get the most insurance for the least amount of money. At some point, you have enough assets that secures your risk, protects your risk, which is, you're financially okay even if something happens to you. So at that point, term insurance doesn't really serve as much of a purpose because there's, financially speaking, someone's family or estate is okay. In that category, in that component, cash value life insurance, a permanent life insurance becomes an asset, because what happens here is when you fund a policy, premiums are being invested by the insurance company. They give you a balance called a cash value balance, and they credit interest to your balance. And so when someone's becoming wealthy, the more money someone makes, usually when someone starts to earn around $300,000, it's kind of the time that they start to feel the pain of taxes. And so taxes need to be paid. There's no question about that. But when someone starts to make around $250 to $300, you start to notice how much of your income, for sure, goes to taxes. So all of a sudden, any dollar that isn't paid in taxes is a dollar we get to keep. And if we're a good investor, that's a dollar we get to keep and then invest. And so just tax strategies and tax planning in general becomes that much more critical when you start to get kind of up the tax bracket ladder. And so life insurance as an asset, you can accumulate interest inside the policy, and the interest is non-taxable interest that year. And so we can have $100,000 or $1 million earning interest and we pay no tax. More importantly than that, we can take income from the policy and not pay tax on that income. And so we have to earn close to $200,000 of income to net $120,000. If you can take income from a Roth IRA, then you only need $120 to net $120. Same with a life insurance cash value. You can take out $120 and you net $120 because it's not taxable. So as someone becomes wealthier, tax-free income becomes a bigger and bigger deal. Real estate is one of the greatest assets to build wealth because of the asset, the cash flow, and the tax treatment. And then that coupled with life insurance is a way to accumulate really cash or liquidity in a way that has favorable tax treatment. And so real estate and life insurance really work really well together, hand in hand for similar, some of the same reasons.
Yeah. Well, yeah. And so you subscribe to the cash value approach, correct? Personally.
I personally do. Yes, of course. And everyone has to understand there's multiple companies, there's multiple ways of doing this. Yeah. They're not all equal. You can buy real estate and go bankrupt.
Yeah.
So buy policies aren't good. But yes, I personally, absolutely.
Yeah, I knew the answer to that, but I want you to tell the story of how you purchased your office building. And you don't have to give all the lead up and the kind of the drama of the story, but like just the blocking and tackling of it, how you used this approach to actually execute the transaction. That'd be good for the team to hear that.
Yeah. So in the world of wealth building, I'm going to use the term infinite compounding. Anytime we can keep money compounding and be able to use that capital without actually pulling out money and keeping the maximum amount compounding, that's going to be advantageous. If we can do that tax-free, that's even better. And so when we look at our balance sheet to make an investment, you got to have liquidity, you got to have capital. And so, checking accounts, savings accounts, money market accounts, fixed income, muni bond accounts, these are all sources of liquidity. So the cash value life insurance is one of the options for a source of liquidity. It's an option where we can get greater interest, tax-free interest, and have that money compounding constantly. Then one of the most advantageous ways of accessing capital is to borrow against the asset. And so, the more you study wealthy people, you learn that they're borrowing against assets all the time to move money, because you can move money by borrowing against it tax-free. And so for, two most recent commercial real estate investments I made, I have cash in the bank and I have cash value in my life insurance policies. I can borrow 95% loan to value against my cash value. And so that's what I did. So I have cash value, I borrow against it, I pull those funds now into my bank account, and I go to closing and I close on the property. I could have a loan on it, and we did an all cash offer to get the property in a competitive situation. And so, but I used my life insurance cash value to purchase the property. Now I have the property and I've still got my cash value compounding tax free at the same time. And now, I used a loan as a way of transferring funds. So there's no tax paid. I didn't have to sell any assets to create liquidity. And now I've got real estate compounding in value, and I've got other liquid capital compounding with no tax.
And how quick of a close were you able to offer the seller?
Okay, so I found a property that wasn't on the market, and then I meet the owner, and I find out it's a competitive building. People have already got his interest. I said I can close all cash in 2 weeks, and I really could close all cash in 2 days, but you can't set up closing usually in 2 days. So that got his attention, and that was because I had the capital stored up in the insurance policy. And so we were able to go under contract, verbally at least, a verbal agreement about 4 hours after meeting this gentleman, because of my offering of an all cash close soon.
Yeah. And and this group knows with terms like that, you're gonna win in other areas, because that's a huge win for the seller there.
And I was able to get what I felt like was the property at a discount.
Yeah.
Because I was prepared for that.
Yeah. Well, just to give everybody a real quick story, the first laundromat that Kristen and I ever invested in, we used our loan product that was against our cash value policy. And the dividends that we receive from the laundromat business there pay for more than the interest only payments that we owe back on that loan. I mean, we were able to pay that back very quickly. And then, as John was saying, that infinite return, I mean, we really invested in that deal, paid it off quickly, all of that with no cash in it, really. And then not only that, but the money that we have in the cash value, it continued to have the return on that money while we borrowed against it. I mean, we never disrupted that return. So on that point, John, what's a typical return that somebody could expect on the money that they have in that cash value policy?
Yeah, well, there's a couple of different types of products. The most common used in the whole life type of world is I'm just going to say roughly 5%. There's also what's known as index universal life. That's the net is going to end up being very similar to about 5%. And so when I say even just saying whole life, I'm sure someone on the call cringed. There's a lot of negativity about these assets. So the structure of these policies is important. Not all whole life is the same. There's what's called high cash value whole life, heavily overfunded whole life. This is not what Dave Ramsey is referring to, by the way. And so that part is unique. The high cash value, heavily overfunded. This means life insurance built for cash purposes as a priority over the insurance purpose. The insurance becomes a byproduct of the cash asset, as opposed of buying it for the insurance purposes, and the cash value is just a byproduct of the insurance. It's kind of in reverse. And I will add this, Schuyler. When we talk about leverage, the leverage is used a lot of ways in business. Leverage of relationships, leverage of talent, leverage of people on your team, leverage of systems and processes, leverage from the bank, right? We borrow money from the bank sometimes because maybe we don't have the money. So, where we want to be in a position is we have the money, but we're borrowing strategically. That's different. Borrowing strategically is different than borrowing for funds that you don't have. But a lot of people have their first ever home purchase because they couldn't buy the house in cash, right? So that's leverage. But another form of leverage is just when you're getting actions taking place or something's working in multiple areas at one time. And so when it comes to money, when I think about investing or leverage, is when you can have $1 working for you in two different places. So I have two assets that are being funded by the same dollar. That's ultimately what's happening when you utilize the cash value life insurance and you're getting the real estate and investment at the same time. Borrowing against our asset allows us to do that. This is no different than if you have a home equity line of credit and you use that capital to then, do something else where you can make more money, right? So we have our home and we have the other asset. So this is also done with investment accounts. This is not exclusive to insurance, but the mindset of wealthy people is, how do I have $1 working in two different areas at the same time?
Yeah.
And I see that all the time when I'm meeting with individuals who are building generational wealth. This is kind of what they focus on oftentimes as much as anything. Is leverage of their money.
Yeah, and I'll just say, from a simplicity standpoint, Kristen and I we're terrible to underwrite for these lenders that are lending us money to go purchase real estate assets with. When we went to get the line of credit against the cash value policy, a couple of documents, and they were ready to go. The bank was ready to go. So completely different underwriting process and a lot more simple than the real estate process. I'll say that.
Yeah, and there's kind of, not to get too much in the weeds here, but you can borrow. You have a line of credit, borrow from the bank with your cash value collateral, or you can borrow directly from the insurance company. And so if you borrow directly from the insurance company, you don't even have to set up a third-party loan. You guys set up a third-party loan at the time, and so have I, because the interest rates were more strategic to do that. And you could, potentially have a deduction of interest. But historically, if you really study Walt Disney, Ray Kroc, who founded McDonald's, you got the Rockefeller family, they were borrowing from their whole life policies 100 years ago to fund their businesses and buy real estate and expand their businesses in times where banks would not give them money. It's pretty cool to kind of study. I enjoy, obviously, my profession, but I enjoy learning some of these titans of business and how they were getting deals done back in the day.
Yeah. There are fees, but the way I understand it is, at some point, at some value, the money that you'll make on the money invested will outpace the fees that we pay. Is that true? And how does that happen?
Yeah, that's true. If you think about it this way, there is a cost of insurance. I'm gonna say the fee is the cost of insurance, but it's the cost of insurance. The insurance is still there. You still get the insurance. So when there's a dividend being credited, and then there's an expense to go to cover the insurance value, which is greater than your cash value, the net is being reinvested and compounded. So whatever my fee is, I'm going to get that back because I'm getting the insurance for it. Now, my generations are going to see that. My beneficiaries are going to see that, but that's not money lost. And that's important to understand.
Yeah.
When you help someone with real estate and there's a commission, that's a very well-deserved commission that's paid. But that's money that I'm never going to see again. If we're managing an investment account and there's a fee, standard 1% fee on $1 million investment account, that's revenue to my business. The client's never going to see that dollar again. When there's a fee on the insurance or cost of insurance, my $2 million in cash value at some point is going to become $6 million of cash because of the insurance. So you're actually always going to cost recover at some point in the policy. You could even say the tax savings is cost recovery. But ultimately, the point is you're going to pay those fees on your money somewhere. So are you paying them to the bank, or are you paying them to an advisor, or are you paying them to future generations of your family?
Yeah.
Which is unique about insurance.
Yep. So let's say let's say I have $500,000 in cash value, and and I pass away tomorrow. What would my family see from this?
Yeah, it obviously depends per client, per age, and all of that. But the kind of a ratio might be closer to $2 million. And so you think about it as I've got $500,000 of cash value, which is on my personal financial statement. Anybody has a personal financial statement? Look in the top left corner. It'll say cash or cash equivalent. It'll say checking, savings, money market. It'll say life insurance cash value. So that's where the $500,000 goes on your personal financial statement. You show banks. If something happens to me, and then all of a sudden that 500 becomes 2 million. So it's like overnight, it magnifies to 2 million. There's no tax paid on that extra 1.5. That's pure tax-free insurance, pure income tax-free insurance. So later on, that might be in a trust, possibly to keep it estate tax-free. But the point there is, I call that's a leverage of the insurance. That could be a larger number sometimes. Typically in these kind of policies, you want the insurance to actually be as low as possible to keep the cost of insurance low, which will accelerate the cash accumulation side.
Yep. Okay. Couple of different questions here. And I'll just say I subscribe to these next two, but I want you to explain it. What's an umbrella insurance policy, and why might you want that as an individual?
Sure. Well, so just from a compliance standpoint, I'll say I don't have my property and casualty license anymore. I did at one point, and my family does. So I'm well versed here, and would advise everyone have a liability umbrella policy. So I have a $5 million liability umbrella policy. So I'll speak to me. Our cars and our home, our auto insurance and our homeowners insurance has liability insurance. So you and Kristen come over to my house, you slip on my side of my house, you sue me for whatever reason, my liability insurance covers that on my home, on my property. But let's say that lawsuit was over $1 million and that was my maximum limit on my home, then any amount over 1 million is not covered. So the umbrella policy kind of covers all of our assets for a lawsuit up to a new limit. Those are very inexpensive policies, so highly recommend them. A situation that can really come up, you can be sued for future earnings. So someone could say, well, I don't have a whole lot, but you have remember that income is an asset. So they'll say, okay, every year, Schuyler, for the next 30 years, you owe this family $100,000. Because unfortunately, you looked down at your phone when you were driving and you killed somebody. Right. So your liability umbrella would give additional protection in that situation. And I think most people don't understand that you can be sued for future income earnings. That's what the umbrella protection's for.
Okay. What about key man insurance?
Yeah, I think to be politically correct today too, we would say key man or key woman insurance, right? So, or
key person
insurance. Yeah. So this is for businesses or corporations, Coca-Cola to Google to Nike, they all have this kind of for key people. So Schuyler, you're building a big business. I work for you. I'm a key person in your enterprise. Maybe I bring revenue to the company, or I make your life easier. And you say, you know what, if John, hopefully you feel this way anyway, if John is not in my life or in my company, it's going to hurt my company significantly. So you have life insurance on a key employee that is owned by the company that protects loss of revenue if something happened to that employee. And essentially that's the key man. That's where key man insurance comes from.
Yeah. Okay. Anything else we need to know from the insurance world?
I think I sound like an insurance person. No one's ever needed insurance and thought, you know what, dang it, I have too much. I just shouldn't have paid for that much. So I think the notion of having too much insurance is just as a statement of not understanding insurance. Insurance is leverage, it's protecting of risk using someone else's money. It can be done in a very cost-efficient manner. So it's important. It frees up other money to be put to work. Liability insurance and term life insurance are two of the most important insurances you can have. They're both incredibly cheap because they're not likely to happen, but they're the most catastrophic financial situations to someone's family or situation. And so I would err on getting a lot of insurance for the least amount of money, and there's ways to do that, with reputable company. The bigger thing here is back to who you surround yourself with, and just having individuals that you trust. You think about your life and advisory team. You have a real estate advisor, a financial advisor, an insurance advisor, a tax advisor, attorney, other advisor, mentors in your life. I just kind of put all these seats around you, and that's one of those seats at the table. And just having the right person that you can trust is probably priority number one.
Yeah. What book are you reading right now?
Oh man, I just finished. Hold on. I just finished Disciplines of a Godly Man, which is probably
do you recommend it?
The most impactful book I've ever read. And I think part of that is my stage of life, but I wish I would have read it 10 years ago. And then the second one I just started is called The Intentional Father.
Right.
And this is, I think there's one written for daughters. I have one son and two daughters, but this is a practical guide to raise sons of courage and character. This is kind of a little smaller book, but I just started this one.
Love that. Okay. I want to make sure that we give folks time to ask questions. So if you have a question, just unmute yourself and just tell us your name and ask your question here.
Hey there, Schuyler. I don't mind going first, if that's all right.
Yeah, please do, Jose.
Great. Hey, John, thanks for the book recommendations and for being here. I really appreciate you. I just wanted to make a distinction and make sure I understood when you were talking about cash value. Like, is that difference from like the value of the actual, like the face value of the policy? Like when Schuyler was given that example of like you get a $1 million policy, but you can't borrow against that 1 million, right? You're borrowing against what you've kind of accumulated. I just wanted to make that distinction or to clarify that for me, please.
Yes. Well, first of all, thank you for your comment. Yes, there's the insurance value, and then there's the cash balance value. Think of it as the insurance value is the big number. The cash value balance is the number inside the policy. So that's the money earning interest. It's inside the policy. And then there's a greater insurance value. So a $1 million life insurance policy might at some point have $100,000 or $200,000 of cash value inside of it. And so you can borrow 95% of the cash value balance. And then when actually if someone passes away, the life insurance will pay off the loan against the cash value balance, and then the proceeds or the net value, which is the life insurance minus the loan payoff, is the net balance.
Got it. That makes sense. Okay. And is there a time frame that you have to pay off? Like if you take a loan out against the cash compound interest, is there a time frame you have to pay that back within?
No, there's really not. Now, if policies are not structured correctly, there could be a situation where like, hey, you need to pay this back at some point, but or the policy could collapse technically. Now, I'm speaking to a very narrow scope of policies that are out there. I'm just making sure I give an accurate answer. But if it's structured correctly, no, it's your capital. Your capital's backing the loan effectively. So, you're paying yourself back essentially. And so you can do that at any point in time. Normally you're using the money for something you need or an investment. And so just as you have more capital come in with income or make money in your investment, you got to put it somewhere. So usually just cash flow that back towards the loan. But it's your money, so there's no loan terms or timelines or things like that.
Yeah, I'd say, Jose, just from my own personal experience, it's interest only payments for 10 years. And if I don't pay it back in 10 years, then they're going to put it on a fixed payment, but it would be on another 10 years. So
Oh, right.
you're gonna pay it back in that 10. Well, we've paid ours back very quickly, but it's easy, I think, to make those payments to get it back there within the 10-year period.
Yeah, and even Schuyler, what Schuyler's referring to is where you have a bank line of credit backed by the policy, but you could always change that loan to the policy loan, and the policy loan really has no timeline.
Yeah. Okay.
Awesome. Great.
Yeah.
Thanks, John.
Yeah, and I think kind of a question that maybe someone could have that I didn't really touch on is like when do you do this? You know, like who is this for and who is it not for? And I think it's important to understand this kind of comes in a sequence of other things. Like this is like the fourth or fifth asset or thing that you might put money into. So normally this is when someone, you know, has minimum personal debt, let's say like outside of mortgages, minimum personal debt, you know, cash reserve buildup has taken place, you know, credit card debt is, you know, being paid off every month. And, you know, if someone has a 401k, they're taking advantage of the 401k first, usually, you know, at least up until the match. If you can do a Roth IRA, like that can be great to do in the next sequence. A lot of times, if you're making that $300,000 income level or more, at some point you can't do a Roth. So then this kind of comes. So this is kind of, you know, you've got your cash, your minimum debt, cash, 401ks, Roths, and then this is sort of that next layer of where clients are saying, hey, what else can I do that can have long-term wealth building benefits that I'm not already doing or I haven't already taken advantage of? And that's kind of where a lot of times this comes into play. A lot of this gets a bad reputation, honestly, Jose, because advisors in the industry, believe it or not, can be greedy or pushy, or, you know, they're trying to convince someone to do something to get a sale. And the reality is this is all about the right time for the client. It's very important. You know, it's kind of when you have excess cash flow, like, hey, what else can I be doing when I've taken advantage of kind of all the you know, sort of the more obvious things first.
Makes sense. Yeah. On the flip side, like who would it not be right for?
Yeah, well, I mean, you know, most Americans have a lot of personal debt. You know, they are paycheck to paycheck. There's not a lot of money being saved. They can't go 6 months without income. And all of those, you know, many people that have, you know, credit cards and making payments on, you know, most of all those situations, I'm going to say like, hey, just regular term insurance is what that individual needs. They need to get these other things in a better position first. Another thing is life insurance. So you have to qualify. So if someone has some health challenges or is not healthy, it may not be the right thing, even if they can get approved, because you know, the cost of insurance may be too high. So all of a sudden the net return might not make sense for them due to the cost of insurance that can be tied to their health. I've had clients start these policies in their 60s. So, you know, sometimes it can be age, but more often as people age, they just aren't as healthy. But if they're healthy, then certainly someone in their 60s or even, you know, or mid to late 60s, this can still be, you know, part of their planning.
Great. Thanks again.
Amen. And thank you for your thoughtful question.
Anybody else?
And I know the insurance isn't the most exciting thing to talk about. So if there's no questions, that's okay. My feelings aren't hurt.
Well, I asked you several.
Yeah, you did. Several great questions. So,
okay, we'll wrap up. Jessica, can you go to the last slide for us? Hey, you guys. So here's my. We're kind of going to church here. I don't charge you guys for these events. So if you thought you received value here, what we ask is that you Venmo the corporate battlefield, $5, $10, whatever it may be. And what we're doing is we're taking that money and we're giving it to teachers here in Austin. I read a report about 8 months ago that kind of laid it out. Someone who's a teacher in Austin, unless they have a roommate, can't even afford an apartment here. And I've got young kids. Those teachers are influencing my kids almost more than I am throughout a day and a week. So we need talented people to step up and be teachers. And you know, we're just stepping in where we're in. So we've been able to give thousands of dollars away to teachers that are great at what they do, and the car broke down, or they missed a payment, or you name it. So again, you don't have to do anything, but if you're able, whatever you can give, we'd be grateful for that, and we give 100% of that to the teachers. All right, John, I appreciate it. Do you have any closing remarks that you want to leave us with?
I was just Venmoing, so
You're the man.
I just encourage everybody, like when you're out in the world, you never know what people are going through. Seek to understand first, get to know people's stories, and seek to, we can learn from everybody. And who you surround yourself with in those relationships are the most important things that are going to impact our life. And at some point, we're the people that are impacting others just as much as people are impacting us. And every day is a gift, and it was a pleasure to be with you today.
Yeah, thank you, John. Grateful for you. All right, y'all remember, we've got our live event next month, and in October, we have our big national conference that we're going to do. So we'd love for you guys to attend that. All right, everybody, appreciate it. Thanks, John.
All right, thank you, man. Take care.